Good morning, Michel.
Good morning.
This summer was not bad for the Eurozone, but now the bad news come from emerging markets.
That is true. We have some positive news coming out from Europe. However, we have really bad news coming out from the emerging countries. Stock markets are falling, currencies are falling, 25% in 3 months for India and Brazil. And these markets, which were considered as an alternative to developed countries a few years ago, are in a worrying situation today.
But they have a higher economic growth.
It is true, figures are still higher. However, we have to understand the dynamic among these countries. A few years ago, these countries have been able to trade together, and that has accelerated the economic growth among them. Today, we have the reverse dynamic. The economic growth is falling, and then for everybody is negative.
And the debt is lower than the Eurozone.
But that's no more true. If we look at the private debt level, actually, if we look at China, if we look at Korea, if we look at Thailand, these levels of private debt are very high and very similar to the level we have seen in Spain before the crisis. And if we look at the public debt in India, it's already above the Maastricht criteria. So we have a debt problem in Asia anyway and in emerging countries.
And in this condition, what about the private capital flows?
But these capital flows are leaving this region of the world because the economic growth is no more there or less interesting. And in the same time, the change of the US monetary policy has pushed up interest rates in US dollar assets. So the money is going where we have more yields to get. And that pushed these local currencies downwards. And in these circumstances, these countries have to raise interest rates. And that creates the seeds for potentially a financial crisis in some of these countries.
And should they benefit from a better European condition?
Normally, that should be the positive news. Because if Europe is getting better, that means Europe will buy more products from these countries and they will export more. And normally their exports to Europe is about 15 to 20% of their total exports. But you have countries like India, which has a trade deficit. So the devaluation is getting a negative impact on India.
And we see a lot of bad news. And so is it the time to invest in emerging markets?
You're right. Normally we have to invest, be brave when we hear the bad news. And we have really bad news today. But the timing is quite difficult to assess. However, we know the bad news are the tightening of the US monetary policy, the rise in interest rates locally, the devaluation of currencies. And on top of that, that's true, we have potentially another problem with the rise in the oil price due to the conflict in the Middle East. However, the good news are these markets have underperformed since 2 years now. So something is already in the price in these markets. And the second good news is valuations are getting back to normal level. And the third news, which is positive, at this level of cheap currencies, you're buying cheaply these markets. So when I try to make the conclusion, I would like to say, yes, we have to be prudent, but an opportunity is opening up. And probably these markets will be an interesting joker for next year in terms of investment.
Thank you very much, Michel.
Thank you.